is a sight for my soul.
So here, we're going to go through the difference of a policy loan, which I would take directly from my insurance policy, and a collateral loan, which would assume I take my policy to a lender or a bank that does this, assign my cash value as collateral, and then they give me a loan, similar to a line of credit. So how the two work, let's go through a very simple case study. Firstly, we have a policy loan. We're going to assume we have a dividend rate of 6% and a loan interest rate of 5%. We'll use a nice round number. I've got $100,000 in cash value. Let's assume that I borrow $50,000. So what's going to happen? I pull out half of my cash value. What do I still earn dividends on? If I'm getting a 6% dividend, I'm still going to receive that on the non-borrowed funds and the borrowed funds, as if I never touched the money at all. We'll just assume for simplicity's sake that this is a non-direct recognition company or policy. Now, the cost of borrowing, the company's still paying me a 6% dividend. The loan interest expense, we know with the top companies, this is typically going to range between 5 and 6%. For this example, we'll just say it's 5%. So what happens if I take out a $50,000 loan at 5%? How much is that? $2,500. That goes to the insurance company. Okay. So they do make money off of loans. Now granted, they are still continuing to pay me interest, dividends on my entire bucket of cash value. And it's a very clean, easy transaction to borrow and repay from a life insurance policy. If you have an online account, call up the company direct. It is simple. Don't have to qualify for it. No credit checks, nothing like that. I have control. So the collateralized loan, how that works is we will assume the exact same scenario. I've got a policy with a 6% dividend. Now a big difference is the collateralized loan, I can usually get it at a better interest rate. We're going to assume between 3.5% and 4%. Rates can vary quite a bit here. Depends on the lender, depends on my credentials, right? As the borrower, often I have to qualify for it. May or may not be a credit check. The other factors which we covered in our last video. But let's assume we have that rate between 3.5% and 4%. I've got the same amount of cash value, 100K. I take my policy to the bank, to the lender, and say, I've got this policy here, I want a loan, just like a line of credit with real estate. Say it's for $50,000. What happens is there's a collateral assignment on my life insurance policy now to the bank. They give me that $50,000. Let's just assume the interest is 3.5%. Where does that go? Instead of paying 5% to the insurance company, I'm paying 3.5% to the bank, lender, whoever it is. So my interest expense is slightly less. What happens with the interest earned? That 6% dividend. Well, that's still paid on the 100K in cash value regardless. Literally makes no difference here. If I'm going to get that 6%, whether I just borrow from the policy, let the money sit and grow, or take the money to a bank, I'm going to get that 6% dividend. The difference is if I take the policy to a bank and assign it as collateral, there's no transaction as far as me pulling money from the life insurance policy. It's good to be aware of this. It can help us capture a more favorable interest rate. Here's the main advantage next, is that often on the bank or lender's paperwork, I actually get to check off, is this loan for personal use or is it for business use? If it's for business use, what does that result in? Tax break. I can write off the interest. So now, if I have a lesser interest rate, 3.5% to 4%, and I have a tax deduction there, that's a win-win. and I'm continuing to yield interest on the entire cash value as if I never touched it. Those are the advantages to that collateral loan, especially in a low interest rate environment where the rates are more favorable than what the insurance company is offering. Now, back to the disadvantages, which are touched more on the prior video. I do give up control. Right? If I have a loan outstanding, the bank can call it anytime they want. That's usually the case. Often I have to pay at least interest only every month. So they are going to have some control. If I want to make any type of transaction with the life insurance policy, what's going to happen? The bank has to approve it first. They want to make sure their cash is there in case I default on the loan. They've got a source they can go after the money. So good to weigh out my options. Again, if I'm using it for business, that's the real advantage, but it is a good tool to be aware of. And we do work with someone that offers these and can provide more education. Hope this helps.